Hello and welcome to another episode of Market Maker Mondays. I am the Nomadic Trader, and hopefully you've all had a good week of trading and in your personal lives as well. So I've just gone over the previous video just for a bit of a refresh because a lot happened in the week, and I know ICT was really busy on Twitter. I was kind of following along for the first part of the week. But because of other commitments in my life, I had to sort of just drop off the radar for a little bit. I did actually keep the community tab up to date on my YouTube channel. And then for those of you that are in the Discord group, I was shouting out some updates there. But what I want to draw your attention to is I've gone back through on the replay to show the end of last week. So there's no price action on the right hand side of the screen from the current week that's just passed. And I want to draw your attention to the fact that I'd highlighted this is buy side liquidity and then this is sell side liquidity for the near term objectives. However, it's the first time upon reviewing my previous video that what I've realized is this is all good and well, obviously, when the markets are closed, and this is all the up-to-date data. However, on Monday's trading, instantly what we've done is we've actually created another fair value gap. So what I just wanted to illustrate is I've actually highlighted this as the low-hanging fruit because that's what the data had actually provided at the time. However, with one more day's worth of trading, then we've actually got this as the near-term buy side because we've now created another daily fair value gap. And also, it would actually give us the fact that we've just tapped the low of this here. So what we've done is rather than follow through for this here, now we've actually created a bit of a range between this here and this here, or even this and this. So the way that I was actually watching price action is on the daily time frame and the lower time frames, and I'll run you through the lower time frames in a second, but we were taking sell side liquidity, then we were taking buy side liquidity. And what we were doing is we were actually expanding the range. And what that tells me is we were building liquidity within this region here. And I had actually outlined in the community tab and in the Discord group that we were going to be creating the high of the week up into this region here, and then we'll be selling off into the sell side liquidity and below. And where we traded to below this sell side liquidity, which would actually taken this old low on the daily, is the monthly fair value gap upper boundary, which I did actually have highlighted in green if you go through the community tab and you have a look at the screenshots that I shared. So with that in mind, we fast forward another day, we've actually had an outside day here. So we've taken the buy side liquidity, we've taken the sell side liquidity here. We've done exactly the same here, but we're still respecting this daily fair value gap. So we don't want to trade higher than the buy side liquidity here. We've come back down to take the sell side liquidity there. So what they're doing is they're clearing the market on both sides, which means they're going to reprice to a higher time frame objective. So I'm going to go up to the monthly time frame, and the replay isn't set on this, so you will actually see it touch. So monthly bullish fair value gap, go back to the daily time frame. So at this period of time, we've actually got this as the downside objective. And what we were doing is we were actually just consolidating. And then what I'd actually pointed out as well in the community channel and the Discord group is this here is engineering liquidity because people think that these levels are holding strong. However, the narrative on the weekly time frame, okay, so this candle didn't exist. We've got this old low here, but we're expecting the high of the week, power of 3 on the weekly, and then a trade below and a close near the low, which we actually did. And again, that was highlighted as well. So back to the daily. Oh, there you go. So what we've actually done is we've actually used this as a pivot point. We've traded higher, created power of 3 on this. We've traded into the mean threshold of this as a bearish order block. You see that? So range reversal, and then we've traded down below to the pip of this fair value gap. And I did actually make an error because I'd got this level on still, but this wasn't as sell side liquidity. As soon as we'd actually tapped that sell side liquidity, I changed that into just a standard key level. And what that had actually done is when I'd actually got the price bunched up, it was actually indicating this. So I actually called out this level thinking it was this level. So that was an oversight in my part, and I did actually update the group. So where does that actually take us now? So we had a lot of sell side liquidity here, which has been taken. We've actually traded into, or just tapped here and closed back into the range on the weekly time frame, this buy side liquidity here. So this is actually this here validates this order block. So I'm going to keep this video nice and short and sweet because last week it was quite a long video. So that was the recap. We had actually covered the fact that this is a monthly swing high, so we are expecting lower prices. Where's that going to go? First of all, it was this weekly and daily old low here, as well as the near-term liquidity that was building below all the lows on the daily, as I outlined as well. And then we've actually got this monthly fair value gap, so we could expect to see some form of a reaction here. However, on the monthly time frame, because this swing high has now been confirmed because it's traded below this candle. So the minute that candle 3 trades below the low of all of the move, so candle 1, 2, and 3 in a swing high, as soon as candle 3 or 4 trades below the low of those candles, then that is actually a confirmed swing high. And also, I mean, you've only got to have a look at the state of the economy, constantly increasing interest rates, squeezing the consumer to reduce spending, and obviously that's all pointing to downside objectives. So we've got this bullish order block here, which is validated as a high probability order block because we have this fair value gap here. So price is heading into this region. So it's only the 2nd of October. Let me just work this out. Okay, so this is actually the month close because this is September candle. We haven't actually started to form the month of October yet because the start of the new month has occurred when the markets are closed. So Monday's trading, which will actually be tomorrow because I'll be releasing this video on Sunday, we're expecting to see the power of 3 up into this. And now what we've got is this here is a monthly bearish order block. So I want to take the monthly threshold of that order block. There you go. So it's already respecting that. So the power of 3 is going to be trading up into this rejection block here. So that's actually, I'll just label that as a monthly bearish fair value gap and delete the words. So monthly rejection block. Okay, delete that now. So the month open is going to be somewhere down in this region, and then we're going to expect this to trade higher into this region and then sell off into this order block here. So that's what I anticipate the monthly anatomy of the monthly candlestick to look like here. And then if we go down to the weekly time frame, so we've got an extended move down here where we've taken the sell side liquidity, we're trading into this monthly fair value gap. The candle here for the month of September was smaller than this, which if you look at the size of this candle here, the size of this candle, and then the size of this candle, For those of you that have watched my DDP or my daily bias video, you will recognize this as deceleration. And for those of you that are just watching this video, I definitely recommend that you go back and you watch that video as well as last week's, because a lot of topics were covered that brings all this together. So this does look like deceleration. So we could just be pausing, or we could actually be due a bit of a swing low form here, because we've got this higher time frame, which is the monthly, which is higher than the weekly. So the weekly, we wouldn't expect to just simply trade through the monthly unless we were in some form of panic mode, because the monthly time frame is one higher time frame above the weekly. So I will be expecting or anticipating, sorry, some form of a swing low here to come back in to close some of this range. If we hide that, this is actually a weekly fair value gap that we've created. And then this is actually currently the dealing range, because we've taken the sell side liquidity here, we've taken the buy side liquidity here as we traded into the fair value gap, and we've created this imbalance. So into this week, if I was a betting man and I wasn't actually using any of the price action that forms after recording this video, I would expect a trade lower to create some form of a swing low here, to then into next week or the following week come back into closing some of this imbalance. However, I can't predict price action, we can only react to it. We need to anticipate what is likely to happen. The momentum is definitely still to the downside until we see confirmation of this level here. And what that would look like, sorry for jumping up and down the time frames, is a 1, 2, 3 monthly swing here. So I wouldn't expect it to happen next week, because we haven't actually traded deep enough into this region, unless we wanted to leave this open for the retracement to close in some of this and then come back lower. However, I will anticipate some form of a follow through into the previous weekly low. So I'm going to have that on my chart as previous weekly low. So I'll be expecting a follow through on Monday and Tuesday's trading, and then I'll be looking for a 1 and a 4 hour confirmation as to whether or not we want to come back up to close in some of this range before then the following week after next week to come back down and then do this. Obviously that might never happen, and we might just come in lower, and we need to be aware of that. I think I've given you a bit more of an insight into what we could be expecting into this week's trading. You've got your key levels here, and I will take a screenshot of that now, save it so I can upload it to the tab. And then I did say that we'll have a look at how we traded here. So if we go back, it was the 23rd, wasn't it? Yes. So this is how we left last week. So I'm going to change that to a key level. So this was actually the end of last week's trading. What we've done is on the 4 hour time frame, we've traded higher up into this 4 hour fair value gap here, and then we've come back lower to pair that with the sell side liquidity here. But all we've done is we've actually created equal lows here. So as this started to break higher on the 15-minute time frame, people were expecting this level to be support. So this is engineered liquidity. This has also engineered liquidity when we've taken this engineered liquidity, and then we've created a run lower to engineer more sell side liquidity. We've come back up, and then this was actually on the major news announcement for the week. So what we've done is we've traded back up into this 4 hour fair value gap here, which is the mean threshold, or just above that fair value gap, which resides within the higher time frame daily fair value gap. And then we've taken all of this buy side liquidity, and then we've traded lower, and then we've created this equal move lower, so AB equals CD, and then we've just closed off on the weekly range. So what does that look like on the 1 hour? Hopefully some of you that are actually taking this seriously, not my video seriously, but learning and trading in general, you will have actually gone through the week to see the potential setups and also any missed opportunities that you may have done, and then you journal those, and it helps to imprint those in your mind. So what we've done there is the 1 hour time frame will give you your grab on liquidity. So that's either a fair value gap on the 1 hour, or it's an old high or a low. So this here, when you go down to the 15-minute time frame, we've traded, so we've created the low here, and then this was engineered liquidity. So you've got lower lows, lower highs. So this is bearish price structure on the micro and the lower time frame, so 15-minute and below. Then what we've done is everybody stops above here. We've traded higher on the London Open. So 2 a.m. on New York Eastern Time is actually 7 a.m. on the London Open. So London Open, the volatility comes into the market. We've actually had the Judas swing here. And then what we've done is as soon as we grab this liquidity, you go to the 5-minute time frame. And this is your swing low here. In fact, so there's your swing low. There's your fair value gap there. There's your other fair value gap. So because you've got the two, you actually permit it to close in the rest of that. And to have it safe, I would have the stop loss above this candle. So you're giving away a bit to the market. However, because you've got a fair value gap entry here, because you've got your swing low, which is actually traded down, you've got your displacement, you've got your retracement, you've got a fair value gap above your entry, so you permit price to trade up into and close in the imbalance here. So that's where your stop loss would have been, and your internal range liquidity would have been here, because this is your fair value gap on this range, and then your external, and then sorry, this here would have been internal range liquidity, so target number 2, and then to completely come in and to take that would have been your full target for your external range liquidity. And then we've actually done exactly the same here, shifting market structure, and then this is your New York trade. So obviously with the overall weekly expansion to the downside, you're only looking for short sells. So for short, sorry, I overcomplicated that, my apologies. So that's been taken. We've had this here, which is now created induced sell side liquidity here. We've traded above that into the New York Open. So 10.15, that's actually reversed. We go down to the lower time frame again. 5, 4, 3, 2, 1 time frame. Okay, so on this time frame here, we don't have an imbalance. We don't have a fair value gap here. However, we do have a swing low here. We've traded back below into the range below this high. I'm only on the free plan, so I'm not paying for trading view, so I can't view the 4 hour. It goes to the 3 minute, sorry, the 4 minute. Okay, we've actually created this here, which is an imbalance, but there's no fair value gap. So go down to the 1 minute time frame. And here we go. So we've taken the buy side liquidity into the daily fair value gap here. So that is a high probability trade. And then we've traded back in below here with displacement. We've swept this. So this is a shifting market structure. In fact, it's actually a breaking market structure because we've already got the shifting market structure here. We've created the fair value gap here. So this would have been the perfect entry. So within this leg, and then I'm going to put it at the top of the range there, because if you were to have entered at the lower range here, then just for clarity's sake, you'd have actually been entering at a discount. So you always want to be entering in a premium. So even if you had that on your 50% mark, and then candle number 3, and then if you wanted to take target here, which is your internal range liquidity, you could do so. 3% on that just for your internal range liquidity. Your external range liquidity would have actually been below the relative equal lows here for almost 10%, which was an absolute outstanding trade. If you're following the rules completely, then you want to be looking at taking profit here. So if you're seeing a shift in market structure into the London hour, the lunch hour, then you'd want to be taking your profit here. However, if you're holding that with confidence because you know you're trading from a daily fair value gap, you're looking for these equal lows, then that would have been an absolute outstanding trade. And then what we've done is we've created this as engineered liquidity, and I'm going to just remove all of this. So we've got just trading into Wednesday's trading session, and let's have a look. So last week on Wednesday, we had FOMC, the Fed speaking, and home sales. So home sales would have been something to look out for, but at 10:15 we had the Fed Chairman Powell speaking. So let's have a look at the cross-reference of time. So we've gone super early with the volatility of the New York Open. So there's your 8 a.m. volatility, 8:30 a.m. and then you've got the New York Open there at 9:30, and that's where the volatilities come in. So that would give you I'm not going to go through the rest of price action here, but you can see how we just continue to do that as we meander lower. We're engineering liquidity on both sides of the market, and it was easy pickings, really, providing that, I mean, if you're trading higher, then you want to be doing that on a reduced risk. So for me, on my risk management, that's only 0.5%. And if you're taking a short, for me, that would be a full 1%. So that's an overview of last week's high time frame price action, the narrative, look into an anticipation for the following week coming up, and then also a deeper dive into how we're using the 2022 ICT model. So props, ICT, thank you for sharing all that. And that's given us a bit of a scope in how to actually bring in the volatility from the news into the lower time frame zones. And for those of you that are asking, I use a few indicators, because here you can see we've created the London high, the relative equal highs here, and then during London we've taken the high of this, and then we've also taken the high of this as well. So when you're seeing a grab on the liquidity for the trading session, so here we go. So this would have been New York's low here. We've taken that, we've moved higher. We've taken the high, we've moved lower. You need to be looking at the liquidity on daily highs and lows, weekly highs and lows, monthly highs and lows, as well as session highs and lows. So I use the FX market sessions indicator, and I just toggle that as and when I am looking to see if there's any relevance, because otherwise it gets a bit cluttered. I use the ICT futures index, and I've fully configured this for the price action that I want to look for, with the times, the levels. So I've got the daily high here, I've got the daily low, really grayed out so you could barely see it. So I have to hover over that, but I can see as the price action is expanding, what's the daily high and what's the daily low, because that would give me an insight into the power of 3 on the daily candle. And then I've got just a fair value gap tool by Nephew Sam, because it just makes it nice and easy to see them as and when they occur. So thank you very much for watching this video. If you aren't subscribed already, please do. Click on the About page and the info page on the comment section, and all of that lovely stuff in the description. All of the links are there for the Discord group. Please also keep an eye on the community channel. I don't post a lot of videos or updates, so please feel free to use the notifications icon. That will actually enable you to get notified when I do post a midweek update on the community tab. I don't release a lot of content to keep it nice and short and concise. And also in the coming week or so, I will be releasing my entry criteria PDF with a video alongside that to explain exactly how I look at that criteria. And I'll give you a quick